At 10:02 a.m., everything still looks normal. The doors are open, people are chatting. Money feels safe. By 10:11, it isn't. Not because the bank changed, but because people did. It always begins quietly. One person walks in and withdraws more than usual. Maybe they read something. Maybe they heard a rumor. Maybe they just felt uneasy. Nothing breaks, no alarms, no headlines, just a small shift. Then another person does the same, and another. And that's when the system starts to reveal what it really is. Because here's the part no one advertises. Banks don't actually keep most of your money. When you deposit 100, the bank doesn't lock it in a vault. It might keep 5, maybe 10. The rest gets lent out. Mortgages, business loans, credit cards. That same money is already somewhere else, doing something else. So when the third, fourth, 10th person shows up asking for their money back at the same time, the bank has a problem. Not a fraud problem, a timing problem. At 10:17, the branch manager notices withdrawals are higher than usual, still manageable. They dip into cash reserves. That's what reserves are for. But reserves are small by design, because in normal times, people don't all ask for their money at once. The system relies on that assumption, quietly, constantly. At 10:26, reserves start thinning out. The bank now moves to step 2. It begins selling assets. On paper, the bank looks healthy. It owns loans, bonds, financial instruments, but those aren't cash. They're promises of future cash. And turning future cash into immediate cash is expensive. Imagine trying to sell your house in 10 minutes because you suddenly need money. You won't get the best price. You'll take whatever someone offers. That's exactly what the bank does. It sells fast, which means it sells cheap. Losses appear.
At 10:41, those losses start to matter. Not just financially, but psychologically. Because if someone is watching, another bank, a large investor, even a regulator, they start asking questions. Why is this bank selling so quickly? What do they know that we don't? And just like that, suspicion enters the system. Now, we move to step 3, borrowing. The bank reaches out to other banks. This is normal. Banks lend to each other every day to manage short-term gaps. It's called the interbank market. But here's the catch. This only works when trust is intact. If other banks believe everything is fine, they lend, quietly, efficiently. If they hesitate, even slightly, liquidity starts to freeze. At 11:05, a few lenders pull back. Not completely, just enough. Rates go up, terms get tighter, questions get sharper. And that's when the real problem begins. Because up until now, the issue was cash. Now it becomes belief. Outside the bank, the line is longer. People aren't just withdrawing anymore. They're watching each other, reading expressions, interpreting delays. A 3-minute wait feels like a warning. A 10-minute wait feels like confirmation. Phones come out. Messages spread faster than facts. Something's wrong. I heard they're running out. Better withdraw now just in case. At 12:22, withdrawals accelerate, not because of new information, but because of shared fear. This is the moment the system flips. It's no longer about whether the bank has enough money, it's about whether people think it does. And those two things are not the same. By noon, the bank has technically done everything right. It used reserves, it sold assets, it tried to borrow. But none of that matters if confidence is collapsing faster than cash is arriving, because confidence moves instantly. Cash does not. And here's the uncomfortable math. If a bank holds, say, 10% of deposits in liquid cash, it only takes 10% of customers withdrawing at the same time to drain it. That's it. Not everyone, just a fraction. Which means the system isn't built to survive panic, it's built to avoid it. There's a difference. At 1218, regulators might step in. Emergency lending, liquidity support, sometimes even public statements. This bank is safe. But by the time those words are spoken, the audience has already decided whether to believe them. And belief, once shaken, doesn't recover on command. There's a strange irony here. The bank can be solvent, meaning its assets exceed its liabilities, and still fail. Because solvency is about long-term value, but survival is about short-term trust. And those operate on completely different clocks. Now, zoom out. This isn't just about one bank.
Every modern banking system works on this same structure. Fractional reserves, interconnected lending, confidence as a foundation. It's efficient, it fuels growth, it keeps credit flowing. But it also means stability depends on something intangible, a shared agreement that the system works. Break that agreement, even briefly, and the system behaves very differently. This is why bank runs spread, not through balance sheets, but through perception. One bank struggles, people notice, they start asking a new question. If it can happen there, where else could it happen? And suddenly, the issue isn't isolated anymore, it's systemic. This is how localized fear becomes widespread instability. Not because all banks are weak, but because all banks rely on the same fragile ingredient: trust. Now here's where reality diverges from the story we're told. We're told banks are safe because they're regulated, because they're backed, because there are safeguards. And those things are true, but they don't eliminate risk. They manage it, they buy time, they slow down panic. They don't remove the underlying structure, which means, at its core, the system still functions the same way it always has. Money moves, cash is limited, confidence fills the gap. And when that confidence disappears, even briefly, the gap becomes visible. At 1 p.m., the bank might still be open, but something has already closed. Not the vault, not the accounts. Belief. And once belief is gone, restoring it is far harder than losing it. Because people don't just react to facts, they react to what they think other people will do next. And that's the real engine of a bank run. Not withdrawals, expectations. So when we ask, what happens when a bank runs out of cash, we're asking the wrong question. The more accurate question is, what happens when people realize how little cash was there to begin with? And once you see that, the system doesn't look broken. It looks exactly like it was designed. Which raises a final, uncomfortable thought. If everything depends on trust, what happens the next time it disappears a little faster?